The following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And it is Saturday, and we're talking about money. We're going to talk about how much money do you need to retire? What are the criteria? That's coming later in the program. Will you have enough? That's coming up. You also want to hear my guest on the program today? It's a very interesting thing. This is something that goes back to the time I started in the business, and I just heard it talked about on CNBC. So you want to hear what my guest has to say today. But I want to begin. I want to go back in history a little bit and talk about the Eiffel Tower. The Eiffel Tower, you know that I lived in France for a year and a half, a long time ago when I was young. And the Eiffel Tower in Paris was originally built for the 1889 Universal Exposition to mark the centenary of the French Revolution, because the French Revolution happened in 1889. So the city authorities granted the builders of the tower a license to occupy the site for just 20 years. That's all they had, 20 years. After which, the Eiffel Tower was supposed to be demolished. One of the rules of the original competition was that the resulting tower could be easily taken down. So when 1909 came, the city was still intent on the demolition. But the presence of a single radio tower at the summit of the tower saved the tower. The city was persuaded by French telegraph officials and the army that the tower was serving a useful transmitting beacon. And on those grounds, the Eiffel Tower was allowed to remain. However, it fell into a state of disrepair because it had been expected to be torn down in 1909. They didn't paint it. They didn't keep it up. And so along came a guy by the name of Victor Lustig. He was a con man. He'd already pulled off a couple cons anyway. And his trademark was he made a money machine to print $100 bills. It took about 6 hours to print a single $100 bill. And for this, you could buy it for $30,000. And just think about that. Every 6 hours, you could roll out another $100 bill, and $100 bill, $100 bill. You could roll out 3 or 4 a day. And think about that. Over the years, it would more than pay for itself. So you hand him over $30,000, and you start the machine, and it prints out $100 bill, and then it prints out another $100 bill. And then it's all paper. Nothing but paper. Nothing but paper. But by that time, he's long gone. But he sees, in 1925, Paris was booming. World War I was over. And the news article was that the city was having difficulty to maintaining the Eiffel Tower. It needed desperately to be painted. So, Victor Lustig forges some government stationery. And he sets up a confidential meeting at the Hotel de Crillon. Now, the Hotel de Crillon sits at the Place de Concorde, where the guillotine sits. And there's a big place sitting around it. It's one of the top luxury hotels in Paris and has been for a couple centuries. And he invites 6 scrap metal dealers. And he tells them, with this official looking stationery, that he's the Deputy Director General of the Ministry of Post and Telegraphs, who have the responsibility for the Eiffel Tower. And the city wants to sell the Eiffel Tower for scrap. It needs to be painted, it needs to be maintained, and the city wants to sell the Eiffel Tower for scrap. And he's been assigned to get the deal done. But because people really are beginning to like the Eiffel Tower, he does it as a secret deal. Now, there's a guy by the name of André Poisson. Poisson in French means fish. You can see where we maybe got the name at poker, where somebody comes in and you take the money, poisson, a fish. Anyway, but that's another side story. Poisson was not really in the inner circle of scrap dealers, but he wanted to be. And he had a suspicion, even as he went in, that Lustig didn't make enough money working for the government, and he wanted a bribe to deal. And sure enough, Lustig did approach him and say he could do the deal for Poisson if Poisson sent him some additional money under the table. And so it was that Poisson won the bid. He paid for the scrap metal out of the Eiffel Tower. He paid the bribe to Lustig, and nothing ever happened. Nothing ever happened. Poisson was so embarrassed by the whole thing that he didn't even report the scam. He lost all that money. He didn't even report it. So what did Lustig do? He repeated the same thing. The Eiffel Tower sold for a second time for scrap, and Lustig walks off. You know, my favorite movie is a movie called The Sting. Paul Newman, Robert Redford. It's set up about a con on a gangster kind of guy out of Chicago. Anyway, but it takes you step by step through the con game. Lustig, by the way, escaped to America before he was really arrested. Anyway, but the con game, and there's a book called The Confidence Game, and the pattern is set up the same way every time. So follow me on this. Step one is called the put up. And this is where you identify the mark, the most important aspect of the whole con game. Figuring out what the mark wants without them realizing it, and then relaying back to them what they want. You talk in terms of the other person's interest, and familiarity breeds affection. Poisson was one of the marks, and the others in the business deal. They were aware of the Eiffel Tower. They knew that the Eiffel Tower needed to be repaired. They knew that it was almost torn down in 1909. So Lustig carefully picked out the marks. That was the put up. The second step is called the play. It's the emotional appeal, thinking reflexively rather than rationally. Rather than thinking the thing through on a rational basis, the mark begins to think about it as something that's plausible. And when something is plausible, we usually need to test it. But when it's a story and it's plausible, we assume that it's true. And the more extreme the play, the more successful it ultimately is. Who would have thought that the Eiffel Tower was going to secretly be torn down? That's step two. Step three is called the rope. They use 6 pervasive principles. They use consistency, they use social validation, they use friendship, scarcity, and authority. And they ask people to imagine the benefits. Think about it. You get to buy all the scrap metal out of the Eiffel Tower, and you get to buy it at a special deal because we're doing this in secret. We don't want anyone to know. You know, you begin to believe that you're better and you've got a great benefit. Step 4 is called the tail, because now you're making people feel that they're special and they want to think that they're luckier. I mean, you're 1 out of 6 people with the luck to be in the Hotel Crillon with the ability to buy the scrap metal out of the Eiffel Tower and not go through a huge bidding process. All you got to do is bribe the guy that's doing it. So you begin to believe you're special, exceptional. Step 5 is called the convincer. This is the payoff. It's the payoff from the Ponzi scheme, where if you invest in a Ponzi scheme, you get a check back. If they tell you you're going to make 20% per week, you get a check that first week that gives you 20% because it's coming from other people. It's the convincer. And it convinces the mark that they've won, that they had really the good luck and the insight to do it. And then step 6 is the breakdown. This is where we lose. This is where we find out how far the whole thing breaks down. And the point of all this is it's similar to what goes on in marketing to us. I live in the financial services business, and it's very much the same. That we're sold a bill of goods on modern portfolio theory and financial planning. I often use the idea that in 1964, Peter Higgs postulated that there existed a particle that was needed to explain the physics in the universe. It became known as the Higgs boson particle, nicknamed the God particle. And that was the that was the explanation for standard model of the forces of the universe that we required. And for 48 years, it was just a theory. But on July 4th, 2012, at the French Conseil Européen de Recherche Nucléaire, the Hadron Collider, they found the Higgs boson particle. Now that Hadron Collider is 17 miles around with superconducting magnets, and you accelerate two high-energy particle beams at almost the speed of light, and then you force them to crash in together, and you find the particles. That's a proven theory. Had that not been found, the entire theory of physics for the last 50 years would have been invalid. Now, how does all that apply to what I'm talking about in terms of the con game and modern portfolio theory? We're going to come back and talk about that right after this commercial break, because it does have an application, and I want to bring all this together. You also want to wait and hear what my interviewee has to say. That's fascinating as well. Don't go away. Stay with me. We'll be right back.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I've been talking about a con game, and I've been talking about physics. You know, if you have a steel ball, you hold it in your hand, you're standing in your driveway, you drop the steel ball, it drops to the ground. It doesn't matter how many times you do it and repeat it, it drops to the ground every single time. And it doesn't matter where your driveway is on this earth. It could be in Singapore, it could be in Seattle, it could be in New Jersey, it could be in Istanbul. Every time you drop that ball, it goes to the ground. If you drop that ball and you expect it to float up in the air, you'll be sadly disappointed. Now, Abraham Lincoln said, you can fool some of the people all the time, and you can fool all the people some of the time. And so let me bring this all together, the con game, the physics, and so on. Step one is called the put up, identifying the mark. And that's the most important aspect, figuring out what they desire without them realizing. And familiarity. You hear the big names, the Merrills, the Bank of America, Morgan Stanley, the University of Chicago, MIT, talking and teaching about modern portfolio theory, about asset allocation. It's what the average person wants in terms of a financial plan. They want to know that every time you go in, you have a plan, you know how to get there. It may take some adjustments as you go along, but it's a plan that's going to get you to your retirement. It's going to furnish your children's education. It's going to do what you need to do. It gives you a direction and a place to go. You know, that's the put up, and it's wide. It's wide. The second step was called the play. It's the emotional appeal, thinking reflexively rather than rationally when a fact's plausible. Modern portfolio theory, it sounds good, right? It sounds modern. It sounds like it's a theory. And it sounds logical and rational. And part of it is the higher the returns, the greater the risk. You've heard that. If you want higher returns, you have to take greater risk. That's the play. That's the emotional appeal. Logical. The third step is called the rope. It's the pervasive principles of consistency and social validation, friendship and scarcity and authority. You know, those people, the big firms will tell you, this is what we do. And as I worked for some of the big firms, the mantra was always to sell the relationship, not the performance. Why would they say that? Why does the performance not count? Why is it the relationship that counts? Because the relationship's an emotional thing. Performance is the numbers. Performance is something you can test and you can look at and you can say, this is good or this is bad. But a relationship is an emotional thing. You like the person. And, if you're going to change, you have to break a friendship because that's the idea. If you have something that's performance-based, you have to look at the numbers and decide if it's good or bad. Step 4, the tail, is people think that they're special because they've been selected. You're a client of a big firm, and big firms, this is something special for you. And you get to meet with an advisor, and you're going to intend to justify your plan. You've got a plan. It's better than no plan at all, and it's gone through the computer. They plugged in all your numbers, and the computer spits out something with lots of graphs and charts and different inks, sometimes red, sometimes blue. They have pictures. They have a beautiful thing. When I first got into the business, I bought the financial planning software because I thought that's something we needed. I spent a lot of money. I bought the very best. And we produced our first financial plan report. It was 400 pages long. It was beautiful. I took it home to read it, and I was horrified. It was so inaccurate. And based on bad assumptions. But that's another day. When I was growing up, I came out of a poor family, and to supplement income, my father raised turkeys, and I hate turkeys. You go in, they attack you. But they had a good life. They lived in this pen. They were well fed. They had water. They had shelter. They had a really good life right up until November. In November, life really changed. The thing is, going back to that gravity example, if you drop a ball, it's going to drop. But with financial planning, modern portfolio theory, things change. Inflation sets in. Great recessions set in. And step 6 is called the breakdown. This is where we lose. If you talk to people who had a financial plan and they went into 2007, 2008, a lot had to work longer. Kids didn't go to the colleges they planned to go to. There was a lot of sadness around that whole time. Why? If we have a modern portfolio theory and if we have financial planning that really, really works, it should be like that steel ball that you drop. You drop and it hits the driveway. No matter where you live, it works. Guess what? It didn't work. 2007, 2008. And I'm going to be talking later in this program today about somewhere else that it will not work. And it's really important because it affects people who are thinking about retirement and thinking about they have money enough for retirement. And I'm not sure that's really true. I think there's a lot going into this, and I view it almost like a con game. It's a marketing thing. It sells you something that sounds logical and reasonable. It sells you something that it looks good. It looks so very good. It's like a chocolate-covered hand grenade. It looks so good on the outside. It looks good enough to eat until you actually drop it and it explodes. We're coming to a time when we're going to have an explosion. And it's not now. It's not this month. It's not next month. And it's not a couple years from now. But the time is to be prepared for it. And I don't believe that modern portfolio theory and asset accumulation does that. And I'll come back to that and explain why. But first, I want to talk to you about my guest. Because even as I was listening to the radio and hearing CNBC, they mentioned that August is the worst month. And where did they get that information? From the Stock Traders Almanac. So let me introduce to you Jeff Hirsch. Jeff, welcome to the program.
Hey, Mike, thanks for having me.
So, Jeff, when I was first in the business, 1986 is when I licensed. Every single stockbroker, and we were called stockbrokers, not financial advisors in those days, every single stockbroker I knew had the Stock Traders Almanac. Tell us about the Stock Traders Almanac.
Well, the Stock Almanac is something I grew up with, and back in '86, when you received it, I may have actually been working in the mailroom with my father at the time, shipping it to you. So I was born in '66, and just months before I came into the world, my father had started this company called the Hirsch Organization for the purpose of creating the Stock Traders Almanac. He had been at a place called Indicator Digest back in the early '60s, a proving ground for financial analysts and newsletter writers and that sort of thing. And it's our older cousin, Sam Coslow, who started it and ended up bringing us into the business. So Yale went out on his own because he wanted to take all the market's indicators and put them together in a calendar form so that one could follow the market schedule along with their own. And he pulled together all of these axioms, seasonalities, cycles, and patterns, and ended up creating and discovering several himself, like the Santa Claus Rally, the January Barometer, the best and worst 6-month switching strategy, which came out in the '87 Almanac in 1986. And everyone dug it, and it hit, and we've been publishing it for 52, almost 53 years now. The 2020 edition is at the publishers to be typeset, and it is a place to know and find out what to expect from the market on any given day, hour, month, week of the year. And a lot of these things that you hear people talking about out there comes right out of our book, just like you heard on the radio watching CNBC about August being the worst month of the year, and it is. Now, it didn't used to be. It used to be the best month of the year back in the early part of the last century, because it was our economy was driven by farming, and it was a sort of all the cash and money coming into the economy was followed along with the planting season. So it was really a buy in May situation versus a sell in May. So that's the sort of gist of the Almanac, and we also have a website and a newsletter that tracks the Almanac and makes recommendations, market timing, sector rotation strategies, and also stock picking. And a friend of ours a bunch of years ago, now we're involved with something called the Probabilities Fund, and Joe Childrey was a broker like yourself. He used to get the book and finally took it with him on a trip one year, and came back a convert and created a mutual fund, or initially hedge fund, based upon the Almanac's patterns and cycles and trends. So that's kind of it.
Well, it's fascinating. And when I first started in the business, everybody was using it as their day timer. I'll bet most millennials don't even know what a day timer is these days. I mean, it's one of those things where now we have a calendar on our computer or on our phone, but in those days we didn't have the computers and the phones. We had physically something that we kept, and day by day, turned page by page. You'd put your appointments in just like you do in your phone. And the Stock Traders Almanac was one of those which every day had some new information. Every day had something, an insight into the market and what was going on in the market. Even if you didn't buy into it, it was still useful information. It had the presidential year. What happens the first year a president's elected? What happens the second year, the third year, and the fourth year? I'm sure that you have the same thing, especially now that we're in the third year of the presidential year and headed into the fourth year. We're coming to a commercial break. Don't go away. Jeff, I want to talk a little more about some of these insights and some of the things people can learn by buying the Stock Traders Almanac. So don't go away. We'll be right back after this commercial break. Got more to talk about.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I'm talking with Jeff Hirsch of the Stock Traders Almanac, Yale Hirsch's Stock Trader Almanac. goes back many years, as Jeff was explaining. We used to use it all the time. It used to be day by day, listening or looking at the patterns it described. And I think some of that really is valid. I talk on this program a number of times about history doesn't repeat, but that it rhymes. You can learn from history, and I think there's a lot of history in the Stock Trader's Almanac. Right, Jeff?
There's lots of it, and it's got its own history now. And, one of the things that we pride ourselves on is the changing landscape. It takes a while for things to change, but things do change. We have something called the indicator graveyard, where we've relegated certain things that are no longer valid or relevant to such graveyard. But one of the big things is the changing monthly cash flows. One of the things that happened in the days when I first started with my father was started to see the influence of the mid-month payroll deductions into the 401ks and IRAs, the automatic deductions. And that money had to go somewhere, and you could see the change it was one of the things I used to track, do the math for by hand and an adding machine and a graph paper in the old days before I turned to Excel, where you see this spike of cash flow and markets going up during the middle of the month, like the 9th, 10th, and 11th trading days of the month, whereas it used to be just the end and the beginning of the month. It's different for individual months. For example, we are pretty much neutral right now, as we have been the end of July into the beginning of August. Very quiet period for the market. So we've been, thankfully for the most part, sidestepping some of the recent downward action in the marketplace. So, there's a lot of things in there, and you can find something for every day. Some things don't work for everyone. There's a couple of great trading strategies that we have in the Almanac, like the free lunch on Wall Street, beating down bargain stocks at towards the end of December that outperformed the market over the next several weeks or so. And the presidential cycle, which you mentioned, very important. We're seeing there's a page that we put in the election year edition, which will be the 2020 edition, entitled "How the Government Manipulates the Economy to Stay in Power." And I think we're witnessing that to a T right now with what's going on with the current administration, as not exactly the same way any other administration would do it, but they're going to be trying to get reelected, and that's what you have when you have a sitting president running for reelection. But the good news is that the chart that I have in the 2020 Almanac, which I also put in our newsletter recently to give people a look at, that is how much better the market performs when a sitting president is running for reelection in an election year versus when it's an open field and there's nobody running for reelection for office.
So all those things are fascinating, and they actually are valid in looking at what's happening. I use some of that things, remembering what was written a long time ago. I use some of that when I do at the beginning of the year my forecast for the year. I talk about presidential election years. It's really a valid observation about what goes on. And what's really...
part of...
Go ahead.
Go ahead. Sorry.
Go ahead.
I was just going to say, part of the reason why the 4-year cycle is so, strong, or at least has been, there's times where it hasn't been, but it hasn't worked always. But unlike other countries, we have a regular election cycle. There's no vote of confidence or no confidence. There's no there's not a fluctuating date where we elect our leader of the nation. Whereas here it's like every 4 years the first Tuesday after the first Monday is when it happens in November. So there's something to be said for that regularity.
Indeed, there is. So, Jeff, tell the listeners where they can order the Stock Trader's Almanac, because I think it's a bargain to get.
It is. I mean, the 2019 is still valuable, and it comes free with our newsletter subscription, which is at stocktradersalmanac.com. You can also buy the Almanac from us. But, Almanacs are available wherever books are sold. Barnes & Noble, Amazon, wherever you like to buy your books. I know locally to check it out. If it's not there, you tell them to get it for you. But you can go to our website and pick it up, or anywhere else to get your books. I'm not going to be able to use your Amex points, but I know Amazon will let you do that if you want to do that. So, you can also track me on Twitter at Almanac Trader. I think what we've done, not just with the Almanac, but with our digital subscription newsletter service, is really had eased the book throughout the year. And that's when I present to people and talk about it, I show the actionable things that we recommend and the trades that we have with specific buy and sell prices, stop losses that have worked out quite well over the years. And again, all available at StockTradersAlmanac.com.
Perfect. So thanks, Jeff. Stock Traders Almanac. Go online, buy it, get it from the bookstore. It's well worth having. So thanks, Jeff.
My pleasure. Thank you for having me.
So I want to switch a little bit and talk about how much do you really need to retire. When I was growing up in the 60s, my dream job would have paid $20,000 a year. And there were very, very few millionaires. Millionaires were something that was a rare breed. Today, you know that 6% of the U.S. population is a millionaire. In the 60s, on the other hand, gas cost 25 cents. I can remember my parents, we were going to go on a camping trip, and they filled up 2 grocery baskets overflowing, and it was $20. They were shocked that they'd never spent $20 on groceries ever. I shudder when I go with my wife to Costco and we buy groceries and I see what the bill is. I started work at $1 an hour, and I got a summer job at $3 an hour. That was the top wage paid in Bend, Oregon, $3 an hour. Times have changed. And so you have to recognize that inflation is a part of our life. And it's more than inflation, because life is changing. When my father was getting ready to retire, as he was getting into his 60s, he was planning to retire at age 62. And one of the options they had, he worked for Pacific Gas Transmission, Pacific Gas and Electric. One of the options they had was a 5-year annuity. So you would get paid your salary for 5 years and then it would stop. Why 5 years? Because most people, when they retired, they didn't live 5 years. Today, the average life expectancy of affluent individuals is 95 plus. Half of us, half of the affluent people, the people that are listening to this program, half are going to be over 95 years of age. When I was growing up, there was a program on TV called Queen for a Day, Art Linkletter, Queen for a Day. And once in a while, once a week or once every other week, they would have a person who turned 100 years old. They would recognize that a person had turned 100 years old. It was a rare thing in the 60s. Today, almost everybody knows 1 or 2 or 3 or 5 people that are 100 years old. So what does that mean for retirement? Life is changing. And when you first retire, generally spending goes down. A lot of activities you were doing when you were working, they begin to go away and spending starts to go down. And then after a few years, costs begin to rise, and driven primarily by 2 things, transportation and healthcare. And I think it's going to become even more complicated as we go forward. Technology is going to be a significant impact on what we're doing. I talk sometimes about a toilet that has been developed in the UK. You use the toilet, it analyzes what you leave in the toilet, your feces and your urine. It analyzes that, figures out what you're missing in your diet, and sends an order to the grocery store to have those groceries delivered to you. Toilet in the UK analyzes. It's sold on the basis, and it's an expensive toilet, I'm sure. It analyzes what you're doing, and I'm sure it has some positive health effects. Our life expectancy is getting longer and longer. But when you look at it, when you look at where we're going with all self-driving cars, with medical monitoring, and all these aspects which are increasing our life expectancy. You have to think about where we're going with our medical and our healthcare system. And I think we have a very significant chance to have a single payer system. If you look at the healthcare in the U.S., we're paying twice as much per capita as any other country in the world. Twice as much. We pay twice as much for our healthcare. And yet the life expectancy in the U.S. is lower than any other advanced country. Not what you'd expect. When you pay twice as much, you have the worst life expectancy. Infant mortality is the worst. So the cost continues to rise. And at one point I calculated how long it would be before the cost of healthcare would take 98% of the GDP. And it's not that many years away. We're coming up to a commercial break, so I do want to finish this off. Don't go away, because the impact of all that's going on is going to have a significant impact on what you need in terms of your retirement and your fund's retirement. Don't go away. I'll be right back.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I started to talk about healthcare because it is becoming and will become and continue to be a continually increasing cost in our system. Already it accounts for almost 1 out of every $5 that are spent out of GDP. 1 out of 5. Think about that. That's more than 4 or 5 times the amount of money we spend on defense. We spend on healthcare. And yet, while we pay twice as much as any other country pays for their healthcare on a per capita basis, twice as much, our life expectancy is worse than any other advanced country. Our infant mortality is the worst of any other advanced country. And you'd expect, if the cost is high, you'd expect our life expectancy and our infant mortality would be better than anybody else's, but it's worse. When I was, and I think there's some reasons for that. So I think we will probably end up with a single payer system. And we know how they work. Every other country in the world almost every other country in the world has a single payer system. So we can see what happens with a single payer system. And the impact, if you look around and see whether it's Canada, whether it's England, whether it's France, whether it's Germany, whether it's Japan, this is the way it works. For the United States, it's going to improve the health for today's uninsured and underinsured. It's going to be a better health care, better than what they receive by going to the emergency room. They're going to have ongoing health insurance. But for the average person, it's going to be worse. So if you look, I think about it in terms of a rotator cuff surgery. In 2003, I tore my rotator cuff. And so I went to the doctor. He said, I think you've torn your rotator cuff. He sent me to schedule an MRI, which I got into. They injected a fluid into my shoulder, said, yes, you have a rotator cuff. Bring me back. They schedule me for surgery. They do the surgery, all within a period of about a month. Now, at that time, in 2003, there were 11 MRI machines in the city of Seattle. 11 MRI machines. In British Columbia, there were 2 in the entire province of British Columbia. Think about that. In terms of population, there would be probably 3 or 4 in the state of Washington to be equivalent to British Columbia. And I don't know the relative populations, but you get the idea. There's 2. When you had a rotator cuff surge problem, you scheduled yourself to go see the MRI person, and it might be 6 months before you got in to see them. And then, if they found that you had a problem, it might be another 6 or 8 months before you could actually have the surgery. So that's what's could be coming and probably will be coming. So what happens in those other countries, the England and the France and the Canada? What happens is supplemental insurance, Medicare Plus or private insurance, so that the average person has the ability to get private insurance, which increases back to where we are today, and or maybe even superior to that. The very wealthy are going to pay that, no question. They're going to have concierge health care, where they have a doctors actually that will come to your home. All that is coming, and it's a single payer system. So as you look forward to retirement, that money you have is going to have to cover not just your average health care, which you're getting and paying for now, but you're going to have supplemental over and above that. And we also know that the economy is probably not going to continue in the same way. The economy, GDP, the growth, we've had 122 months of positive GDP growth without a setback. That's going to come to an end sometime. And we probably will see some dips, nothing spectacular in the not too distant future, but we're going to see that. And if you look back in the Great Recession of 2007 to 2009, we saw the stocks go down 37%, the stock market in general, and come back. It came back in 2011 or 2012. My clients saw new highs in 2010. But we saw a recovery. We saw real estate recover. We saw a lot of people lose their jobs during that time, but now we have record unemployment. We have people at the middle of the Great Recession who said we were going to live with 7% unemployment. How wrong were they? Now we have 3.7. We had several difficult years, but then things have come back and things are going well. People are beginning to forget what it was like during the Great Recession. But if you go back to the 60s and 70s, we had a bout of inflation. And I've talked about this any number of times on the program. And if you look at it, the stocks reached 1,000 in 1966. They were there in 1982. But if you look at the years between 61 and 1982, the value of the dollar dropped by 70%. To buy the same thing in 1982 as you wanted to purchase in 1961, you had to pay 3.5 times more. Stocks recovered, but it was 50 to 70% of the purchasing power that had been lost. Real estate, same kind of thing, 40 to 60% of the value was lost. So over the last couple months, over the last couple years, I should say, there have been several people that came to me and had about 800,000 in nest eggs as they were approaching retirement and thinking that was going to be fine. But for me, I don't believe that's anywhere close to having enough. I told the story about the turkeys. In the first segment of the program, I talked about growing up poor and my father supplemented income by raising turkeys. And we had only about 10 or 15 or 20 turkeys that we raised. And those turkeys had a really good life because they had food, they had water, they had shelter. They had a good life. If they really wanted to, out of that pen, they could have flown out of there and gotten away. Did they do that? Nah. They had food, shelter. They had a really good life until November. And then life suddenly changed. I talked about the financial plans, about the asset allocation, about modern portfolio theory. All that assumes a relatively normal market. All that assumes that things in portfolios are going to be running along fine. But if we get into big inflation, and I believe there's an 85% chance we will, you need to have a significant increase. You need to have a couple million. You need to grow the 800,000 to 2 million or 3 million. 800,000 is not going to go very far if we have the bout of inflation. And by the time we get there, it's too late. You don't buy fire insurance for your house when the house is on fire. You don't buy car insurance when you've had at the time you have an accident and expect it to be covered. Now is the time to plan for and be ready for the Great Recession or the Great Inflation. Because if you're ready now and it never happens, think about what you have. You just have more money. And yes, I realize that past performance is no guarantee of future performance, but I've been doing this for a long time, and I believe that I will continue to do and deliver for my clients. That's where I am and where I take to. And back to the con game, what happens? What happened to those clients who didn't have enough money for the retirement or didn't have enough to send their kids to college? Do you think that affected the big firms at all? No. There's always more fish in the ocean, more people to sell to. For me, it's important that each and every one of my clients does well. And that wraps it up for today. We've been talking about money and how much money you need to retire. If you have a question, give me a call, 206-903-1019, or check my website. I'm around. And until next Saturday, when we'll be again talking about money.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial.